In 1976, borrowing money to buy farmland looked like a safe decision. Interest rates were around 8%. Land prices in Dane County had risen every year since 1968. Commodity prices were coming off the strongest decade American agriculture had seen since the Second World War. The USDA had been telling farmers to expand for most of the decade, and the banks had been willing partners in that expansion. The logic was straightforward enough that it didn't feel like a bet. It felt like the obvious move. A man named Howard Telfer made that move in the spring of 1976. He was 51 years old and had been farming the same 320 acres in western Dane County since 1953. The ground had been his father's before that. He knew every field, every drainage pattern, every spot that held wet in a late spring. He had paid off the original farm mortgage in 1971. He had no debt when the land next door came available. The adjacent 200 acres had belonged to a neighbor who was retiring without a family successor. The ground was good, heavier soil than Howard's East fields, slightly lower, better water holding capacity in a dry August. It abutted his own fence line on two sides. There was no logical reason to let someone else buy it. He borrowed $280,000 at 8.25% over 20 years. Monthly payment of $2,390. Annual debt service of $28,680. The arithmetic was manageable. Corn at $2.80 per bushel, beans at $6.50, and 520 acres of combined production gave him a gross revenue picture that serviced the loan with room to spare. He ran the numbers 3 times. They worked each time. He farmed well. He made every payment. From 1976 through 1981, the loan performed exactly as the math had suggested it would. Howard expanded his bin capacity in 1978 to handle the additional production. He bought a second grain cart. He hired a part-time hand for planting and harvest. The operation ran at a size that matched its obligations, and the obligations were covered. He did not think about the loan often. It was present, the way the mortgage on a paid-for house is present. A background fact, a number in a ledger, a payment that went out on the first of each month and was replaced by the next month's income. It did not feel precarious. It felt like the ordinary structure of a farming operation that had made a reasonable expansion. I want to be precise about that. Howard Telfer was not a reckless man. He was not chasing something beyond his means. He had looked at the numbers in a particular economic environment and made a decision that was defensible in that environment. That matters for understanding what happened next, because what happened next had nothing to do with whether the original decision was sound. Then the early 1980s arrived. Interest rates climbed, not modestly. The prime rate reached 21.5% in June 1981, the highest it had been in the history of the Federal Reserve. Farmland values in Dane County, which had been rising steadily since 1968, peaked in 1981 and began falling. Corn prices weakened through 1982 as the Soviet grain embargo suppressed export demand, and a record domestic harvest pushed supply above what the market could absorb at previous prices. Credit tightened at every agricultural lender in the state. Howard's loan was a fixed-rate note. His monthly payment did not change. That was the one piece of the structure that held. What changed was everything around it. His operating line, which he renewed each spring at the prevailing rate, moved from 10% to 14% to 17% between 1980 and 1983. His corn revenue fell. His land value, the collateral against the 1976 note, dropped from approximately $2,100 per acre to $1,400 per acre by 1983, eroding the equity cushion that had made the original loan look conservative. He was still making every payment on the land note. The operation was under strain, but it was not failing. He had years of clean payment history with his lender. He had equity, reduced but present. He had 520 acres of productive ground and 30 years of farming knowledge. What he did not have in the late fall of 1983 was certainty about how long the strain would continue. He was 58 years old. He had a son named Dennis who had been working alongside him since, finishing at the Technical College in Madison in 1978. Dennis was 31. He had grown up on the farm. He knew the ground. He had been making himself indispensable on the operation for 5 years, learning the equipment, learning the financial cycles, learning the particular rhythm of that soil in every kind of season. Howard and Dennis talked through the winter of 1983 and into early 1984 about the future of the operation. The conversations were practical, the way conversations between farmers tend to be, centered on numbers, on logistics, on what would need to happen and when. Howard was in good health, but was aware that 58 was not a young man's age for the physical demands of full-season farming. Dennis was ready. The question was the loan. The 1976 note had 14 years remaining. The balance outstanding in early 1984 was approximately $198,000. The land that secured it was worth, at current markets, somewhere between $280,000 and $300,000 in enough equity to remain above water, but not enough to provide significant cushion if values continued to fall. The fixed rate of 8.25% was, by 1984 standards, extraordinarily favorable. New farm loans in Wisconsin in 1984 were being written at 14% to 19% depending on the lender and the borrower's position. Howard's rate was a document from a different world. When Howard Telfer died of a cardiac event in March 1984, the loan transferred to his estate and then, through the ordinary process of farm succession, to Dennis. Dennis did not inherit debt in the abstract. He inherited a specific instrument, a note at 8.25%, originated in a world where that rate had made obvious sense, now being carried into a world where that same rate was a privilege that couldn't be recreated at any price. He also inherited the land, the equipment, the grain bins, the operating relationships, and the particular obligations that came with being the person responsible for a farm that had been in the family for 30 years. He inherited something else too. The farm had not been losing money. It had been under pressure. Operating margins compressed, equity reduced from its 1981 peak, credit more expensive than it had been when his father had done most of his borrowing. But the books were not underwater. The land note was current. The operating line was drawn, but not overextended. Howard had been managing the strain carefully, the way farmers of that generation tended to manage hard years, quietly, without announcement, with the particular stoicism that comes from understanding that complaining about interest rates does not reduce them. Dennis had watched all of this from close range. He had been doing the books with his father since 1981. He knew the exact balance on the land note. He knew the operating line rate. He knew the corn revenue number that covered everything and the corn revenue number that did not. He was not surprised by what he inherited. He had been helping manage it for 3 years. What he had not fully accounted for was the weight of it when it became entirely his. Some things you can't understand till they're yours. You can watch it, learn it, live right next to it your whole life. But the day that name on the account becomes yours and yours alone, that's a different feeling. Dennis had been in the books for 3 years, knew it inside out. Still hit him different when there was nobody else to call. The loan Dennis inherited was not a punishment. It was not the result of his father's error. It was a reasonable obligation that had been structured for one set of conditions and was now being lived inside a different set. The payment was the same number. The economic environment surrounding that number had changed by a factor that the original arithmetic had not anticipated and could not have anticipated, because the conditions that produced 19% prime rates in 1981 had not existed in any form the previous generation of lenders or borrowers had experienced. This is the structural center of F beta, and it is worth being precise about it. The decision was made by the person who did not live with the long-term consequences. The consequences were lived by the person who had no role in the original decision. Neither party was wrong. The gap between them was not a mistake, it was timing. I don't know a cleaner way to describe what inheritance means in the context of a farm debt. You receive the asset and the obligation together. The asset is land, something real, something that can be worked and improved and held. The obligation is a number on a schedule written by people who are no longer present in conditions that no longer exist. You didn't negotiate the rate. You didn't choose the term. You didn't decide what the land was worth when the note was signed. You farm inside the structure someone else built in weather they didn't forecast, at prices they couldn't have known. Dennis's situation in the spring of 1984 was this. He was farming 520 acres with a fixed cost structure that had been built for a commodity price environment that no longer existed. His land note payment was $28,680 per year, unchanged from 1976, which was actually the favorable part of the picture. His operating line was variable and expensive. His corn revenue at $2.40 per bushel was generating gross income that covered his costs in most scenarios, but left no margin for a bad year. He had one bad year. The 1984 growing season in southern Wisconsin began well. Planting went in on schedule. June rains were adequate, then July turned dry, not catastrophically, but persistently. Dane County recorded 1.8 inches of rainfall in July 1984 against a normal of 3.6. Corn, that had been making good progress through the knee-high stage, ran short of moisture during pollination. The ear set light. The fill was incomplete. Dennis harvested 89 bushels per acre on his corn ground in October 1984. His 5-year average before that season had been 118. The difference, 29 bushels per acre across his corn acres, was $87 per acre in lost revenue at harvest prices. Against 300 acres of corn, that was $26,100 in revenue that had been projected and did not arrive. He knew by the end of August that the harvest was going to be short. He had walked the fields in the third week of July when the silk was browning early and the ear development was visibly incomplete. He knew what a short pollination corn plant looked like. He had seen it before in dry years. He spent most of August doing and redoing a version of the same calculation. What does the operation look like if yield comes in at 90 bushels instead of 115? The answer was uncomfortable each time he ran it. He ran it anyway. His operating line was drawn to the limit. His November payment on the land note was due. He made the payment. He made it by drawing on a small savings account his father had kept separately. Money set aside over years from equipment sales, from a good bean year in 1979, from the ordinary accumulation of a careful farmer. Howard had not told Dennis the account existed in any formal way. Dennis found the passbook in a desk drawer while settling the estate. The account had $31,400 in it. Dennis made the November payment and the December payment from that account. He sat with the passbook for a long time before he used it. He had not known it was there. He could not ask his father why it was there or whether it had been intentional, set aside against exactly this kind of shortfall, or simply accumulated and never spent. Howard had been a man who did not spend money that did not need to be spent. The account might have been strategy. It might have been habit. Dennis decided it did not matter which. What mattered was that it was there. What mattered was that $31,400 in a savings account in the fall of 1984 was the specific number that bridged the specific gap in the specific year that otherwise would have forced a different and harder set of choices. The precision of it was uncomfortable to think about too long. People talk about the farm crisis like everything handed down was a burden. Wasn't always like that. Sometimes what your dad left you was a savings account in a desk drawer. A habit of not spending what he didn't need to spend turned out to be the exact number his son needed in the exact worst year. Can't plan for that. You just got to be the kind of person who leaves something behind. He did not lose the farm in 1984 or 1985. That is an important part of the story, and it requires explanation rather than just statement. What Dennis did in the winter of 1984 and 1985 was methodical and unglamorous. He sold 80 acres of the 1976 purchase, the lower, heavier ground on the western edge, to a neighboring operation that had been cash solvent through the crisis. The price was $1,150 per acre, well below what his father had paid and well below the 1981 peak, but above the outstanding loan balance on a per-acre basis. The sale generated $92,000, which he applied directly to the principal on the land note. The remaining balance, approximately $106,000 against 120 acres of the original purchase plus his own 320 acres, was refinanced through a farm credit lender at a rate that was still elevated by 1976 standards, but manageable against the reduced principal. His annual debt service dropped from $28,680 to $18,200. The difference was $10,480 per year. In a farming operation running on margins that had narrowed to almost nothing, $10,480 was the difference between a structure that could absorb a bad year and one that could not. He farmed the remaining 440 acres. He hired no help. He ran the operation tighter than his father had run it, not because he was more careful, but because the environment required it. He forward contracted a larger portion of his production each year to reduce revenue volatility. He kept his operating draws below his line limit by 20%, maintaining a buffer he had not needed in 1984 and was not willing to be without again. I've spoken with people who farmed through the mid-1980s in Wisconsin and Minnesota. The ones who came through it tend to describe the period not as a crisis they survived, but as a set of habits they developed. Habits around margin, around reserve, around the specific discipline of not drawing a line to its limit. Dennis Telfer's forward contracting and his 20% operating buffer were not taught to him. They were the direct result of August 1984, when he had walked cornfields in a dry July and run the same calculation 12 times and gotten the same uncomfortable answer every time. The land he sold stayed in agricultural production. The neighbor who bought it farmed it well. From a county perspective, the ground remained in cultivation, remained productive, remained part of the agricultural fabric of western Dane County. The transaction moved ownership. It did not move the land. Dennis Telfer farmed 440 acres until 1997, when he expanded by purchasing 60 acres of adjacent ground, his first land purchase in 13 years, at a price and rate structure that left him comfortable rather than strained. By then, the farm crisis was a chapter in extension service case studies in university agricultural economics courses. The students who read those case studies had not farmed through it. They understood it the way you understand weather you did not stand in. Most of us didn't farm through 84. I didn't either. We read about it, we know the numbers, we understand what happened, but Dennis Telfer didn't read about it. He walked them cornfields in July and already knew what harvest was going to look like before it came. Went home and ran the same numbers 12 times. Not because the answer was going to change, just because he had to make sure he hadn't missed something. That's a different thing altogether. The 200 acres Howard Telfer purchased in 1976 at 8.25% was a sound decision in 1976. The note it generated was a reasonable instrument in 1976. The farming operation it helped build was productive and solvent through 1983. None of that changed what Dennis inherited in March 1984. He inherited a loan that had been written in one interest rate environment and was being carried in another. He inherited a payment schedule that had been sized against one commodity price structure and was now running against a different one. He inherited land values that had been collateral against one set of market assumptions and were now reflecting a different set. The loan was the same document. The world it lived in was not the same world. Dennis did not blame his father. There was nothing to blame. Howard had borrowed at the rate available to him for ground that was worth buying to build an operation that made sense. He had made every payment. He had left the farm in better condition than he had found it. He had left a savings account with $31,400 in it, which turned out to be the specific number that bridged the specific gap in the specific worst year. Whether Howard intended that or simply accumulated it over time is a question Dennis said he never asked. He said it didn't matter. The money was there when it was needed. That was enough. I think about that passbook a lot. The way an ordinary habit, not spending money that doesn't need to be spent, becomes in the right circumstances the precise instrument that holds something together. Howard didn't know his son would need $31,400 in November 1984. He just didn't spend what he didn't have to spend. Those two things turned out to be the same thing. What decisions are you living with today that were made in a completely different time? I ask that not as a rhetorical question. Most farms, most businesses, most households are carrying at least one structural commitment that was made in a different interest rate environment, a different cost environment, a different price environment than the one that exists now. That commitment made sense when it was made. The question is what it means now in the conditions that actually exist, not the conditions that existed when the papers were signed. The loan made sense when it was taken. The son simply inherited the timing.